Hey there, savvy investors! In today's video, we have something truly special for you. We'll be diving into the brilliant investment insights of none other than Warren Buffett and his valuable advice on when to start buying stocks. So let's get right into it. Warren Buffett's comment about his approach to investing during market downturns is indeed thought-provoking and offers valuable insights into his investment philosophy. His statement that he would be too busy buying if the market fell emphasizes his belief in capitalizing on attractive opportunities that arise during market downturns. The implication of his statement is that he sees market downturns as a potential buying opportunity rather than a reason for panic or inactivity. Instead of getting caught up in the noise of the internet or worrying about short-term market fluctuations, Buffett's focus remains on seeking out valuable investments when the market presents them. His mention of the massive cash flows of Berkshire Hathaway highlights the company's financial strength and its ability to seize opportunities when they arise. Despite having substantial resources, Buffett mentioned that they haven't been investing as much in the last 12 months. When it comes to waiting for attractive values, Buffett takes an approach that is both patient and disciplined. According to the Oracle of Omaha, they wait indefinitely for the right opportunities to come their way. It's a fascinating strategy, not rushing into investments just for the sake of it, but rather being extremely selective. Imagine that, waiting indefinitely to make a move in the market. It might sound surprising to some, but this approach is firmly rooted in Buffett's belief in buying only when he finds something truly attractive. It doesn't matter if stock prices fluctuate here and there. What counts is identifying businesses that align with his long-term vision. And that's where patience comes into play. In a world where instant gratification is the norm, Buffett's philosophy stands out. He doesn't get swayed by short-term market movements or succumb to the pressure of making impulsive decisions. Instead, he stays focused on seeking those golden opportunities that have the potential for significant long-term growth. This quality over quantity mindset is what has propelled Buffett to become one of the most successful investors of all time. Let's take a leaf out of the Oracle's book and remember that patience truly is the name of the game. Let's talk about real estate and Warren Buffett's candid reflections on the matter. Despite having a keen understanding of the field, it's intriguing to learn that they have a perfect record of failure in real estate investments. Yes, you heard that right. Perfect record of failure. But why is this the case? Well, it seems that despite their expertise, Buffett and his team prefer to stay away from real estate investments. Instead, they choose to focus on businesses they fully understand. Businesses where they can confidently predict future performance and make well-informed investment decisions. It's a fascinating insight into Buffett's investment philosophy. Real estate, though a potentially lucrative avenue for many investors, isn't necessarily their cup of tea. They understand the ins and outs of it, but it doesn't align with their primary criteria for making investments. For Buffett, it's all about sticking to their circle of competence. They know their strengths and they play to them. So, while they may have faced failures in real estate, they don't dwell on it. Instead, they concentrate on what they do best, identifying businesses with strong fundamentals and sustainable growth prospects. So, what can we learn from Buffett's reflections on real estate? Well, it's a reminder for us to be mindful of our circle of competence. Rather than chasing after every investment opportunity, let's focus on what we know best and invest in businesses where we can confidently predict their future performance. That, my friends, is a strategy worth emulating from the Oracle of Omaha himself. Now, let's dive into the world of Nike. Warren Buffett has high praise for Phil Knight, the mastermind behind the company. He calls Knight a terrific operator, and that's no small compliment coming from the Oracle of Omaha. However, when it comes to discussing the stock of Nike, Buffett prefers to keep his views to himself. That's right, He's tight-lipped about sharing his specific thoughts on the company's stock price and its short-term performance. You see, Buffett and his team have a different approach to investing. They believe in paying a comfortable price for businesses they understand and have faith in for the long term. It's not about chasing after the latest stock market trends or trying to time short-term fluctuations. Instead, it's about having a solid grasp of the business fundamentals and making investments with a long-term horizon. And that's why Buffett doesn't divulge his thoughts on Nike stock. It's not that he has anything negative to say, but rather he follows his investment principles. So, the next time you wonder about Warren Buffett's thoughts on Nike stock, remember that his silence speaks volumes about his disciplined and patient approach to investing. It's a strategy that has served him well over the years and can serve as a guiding principle for all of us as we navigate the complexities of the stock market. You see, Buffett isn't overly concerned about traditional notions of risk. He doesn't lose sleep over short-term fluctuations in stock prices or the so-called volatility that often rattles other investors. Instead, he focuses on understanding the underlying business and its future cash flows. For Buffett, the key lies in having a deep understanding of the business fundamentals. He looks for companies with sustainable competitive advantages, strong management teams, and the ability to generate consistent cash flows over the long term. Once he gains confidence in the business's future prospects, he's ready to make an investment. And here's where it gets interesting. Buffett applies the same discount rate across companies once he is convinced of their qualities. In other words, once he determines that a business meets his criteria for an attractive investment, he values it based on the same discount rate he would use for any other business that meets the same standards. This approach might raise some eyebrows among traditional finance experts who often apply different discount rates depending on perceived risk levels. But for Buffett, it's all about keeping it simple and consistent. By using the same discount rate, he remains true to his investment philosophy and avoids getting bogged down in complex calculations based on perceived risk. Buffett's approach teaches us an invaluable lesson in investing. Focus on understanding the business and its future prospects, rather than getting fixated on short-term market fluctuations or technical financial metrics. By doing so, you can identify quality businesses with strong growth potential. And that's what matters in the long run. If you enjoyed this video, give it a thumbs up and hit that subscribe button to stay updated. Share this video with your fellow investors, and let's all learn from the best. Thanks for tuning in, and see you in the next one. Happy investing!